Big day tomorrow for the Indian economy and economy watchers, to be honest. But officially, Q2 numbers for GDP will be out tomorrow. Now, the first quarter was a shocker. We contracted by nearly 24% in the first quarter, and it was expected and understandable because of the severe lockdown that was put in place due to COVID-19 pandemic. The second quarter numbers are expected to be much better. This is for the June to September quarter, and things had started opening up. We were in the various stages of unlock, and that can be reflected in the numbers we see tomorrow. But the question is, by how much? Let me first go across to my colleague Poonam, who is taking you through what the expectations are for the Q2 GDP numbers due tomorrow.
Well, all eyes would be, of course, in terms of the Q2 GDP data. In fact, if you look at the Indian economy, the rebound has been stronger than anticipated and sooner than expected. In fact, ET now poll pegs Q2 GDP contraction to be somewhere around close to around 8% and it would be supported by agriculture GVA as well as the overall manufacturing GVA is likely to be better than the last quarter. In fact, in terms of the agriculture output, well, a good amount of the carve numbers would of course be seen in Q3, but there would be support coming in from the allied activities which are likely to be stronger in Q2. Manufacturing GVA is likely to rebound as well on account of a blockbuster Q2 earnings season as well as demand pickup on account of the festive season and good pent-up demand. High frequency indicators have also shown recovery to be good. Will it sustain or not? Of course, that needs to be watched out for, but so far we have seen good recovery coming in there. Decline on the services sector as well. Decline in real estate, professional services as well as financial services is also likely to narrow along with public administration and the defense segment. In fact, if you look at the overall expectations, for instance, JP Morgan does believe that if at all we do see a slower than anticipated contraction in Q2, it could lead to more upgrades coming in on the GDP front. We've already seen Moody's as well as Goldman Sachs going ahead and upgrading GDP growth expectations for the full year, and yes, of course, we need to see if the demand is going to sustain or not, but yes, there is a possibility that there is going to be a slower contraction in Q2 GDP. As of now, it is pegged at somewhere around 8% for Q2.
So we will contract for a second quarter in a row, which technically will put us in a recession. The question is, how much of a contraction is good enough? Will we contract less than was expected, and does that sort of give us a pathway to the revival trajectory? To answer some of these questions, I'm joined now by Radhika Rao. She's the India Economist at DBS Bank, and Sameer Narang, who's the Chief Economist at Bank of Baroda. Welcome to both of you, and thank you for speaking with us here just a day before those big Q2 GDP numbers. Radhika, what's your take on how crucial these numbers really are? I mean, of course, this data comes with a lag, but do you think it matters whether we shrink 10% versus 8%? Would that give us some insight into what the pace of recovery will be like?
Hi, Tamanna. Certainly, I think it's going to be very important, because in the second quarter, which is the first quarter of the fiscal year, we did contract by one of the sharpest in the region. So it is very important to see where the third quarter will take us, which is basically the second quarter of the fiscal year. And mainly, and if you rightly so, I mean, this is quite a lagged indicator, GDP usually, which comes with a 2-month lag. What we have seen in the high frequency indicators is that there are a couple of tailwinds which has really helped growth. Certainly, the primary one being virus pandemic curve, which had really struggled to come under control up until July, August, and thereafter we really saw it falling by a third in the number of cases. So there is domestic tailwinds by way of the pandemic curve. You also had festivities that were coming up, and also as the unlocking process continued, you had the pent-up demand that came back as well. So in terms of the consumption story, it looks a lot firmer when you look back at the high-frequency numbers, and you look at manufacturing, which basically capacity utilization picked up. Some of the services also did well, and certainly the the important support is going to come from farm output. Where we are going to see not only output but also rural demand to do with farm fare better. And at the same time, you also had the migrant labor that had gone back, and that has been better engaged because of outlays towards the rural employment scheme has been increased. So overall, I think it is going to be extremely important to see how we fared back then. And I think that will certainly decide the trajectory here on. I would think the headline number would be important, but most important, we should be looking at the sequential change as well, which is basically the quarter on quarter, which had fallen quite sharply in the second quarter. And I think for this quarter, we expect about 10 to 12% increase. Our headline forecast is also around 8%. And, our in-house GDP, and I just want to add one bit here, is that our in-house GDP nowcast model has, interestingly, it earlier showed quite a significant contraction. And between that reading and the one we took in late September, or early October, it showed almost a 4% increase, improvement. So certainly very important to see how we're going to fare here on. And I think going forward, certainly the pandemic curve itself will be very important to realize whether we can really go down this path, or there might be a bit of a correction in the final quarter of the year.
Sameer, the story so far, when we track the GDP numbers and the revival of the economy, seems to be more of a recovery from lockdown than anything else. It doesn't really follow the pathway of the spread of COVID-19 per se, because through this quarter, June to September, the numbers kept rising in terms of COVID-19 infections. It is only, I would say, recently in the last month or so that your daily new numbers across India have reduced a bit, but we're still in a precarious position. Meanwhile, what we are essentially going to see, would I be correct in saying, is how quickly we've recovered from the lockdown and the pace of the unlock. That's what we're going to see reflected tomorrow.
No, you've put it very aptly. That is true. What has happened is that as the economy was unlocked, the rate of infections in India did not multiply at the same pace. So if you see the rate of doubling of infections in India, at the peak it was as high as 20 days. Now we are in a situation where it's as high as 70 days. So the economy got unlocked, but the infections did not spread at the same pace. And that gave us an advantage for ensuring that you can resume most of your activities. What you're seeing in Europe today is that as the economy got unlocked, the rate of infections actually also accelerated at a very fast pace. And a similar situation is being seen in the United States, because of which you have to put fresh restrictions in order to ensure that the spread of the curve can be brought in control and the economy suffers again. And you are going to see perhaps a double dip in terms of slowdown in growth in Europe and perhaps in America also, where the growth will suffer. So that has been an advantage for India. Recently, we are seeing some uptick in the infection rate, because of which some states are putting in restrictions. That will, I believe, impact growth only at the margin, because the restrictions are mostly in terms of night curfew, but not a large change in terms of daily activity. So your assessment is perhaps correct. The benefit that we have seen in terms of sequential improvement in growth and most of the indicators is perhaps because the COVID curve in India has been fairly in control, and that has led to the economy assessment improving for all of us.
Radhika, now tomorrow when we see perhaps -8, -9% headline figure, the first response commonly will be that, hey, look, that's an improvement over Q1. The contraction and the level of contraction is reducing. But in terms of the projection so far, where do we fare with other countries of the region? Is India's growth trajectory following the path that everyone else is? Because one common theme, at least in this part of the world, has been that the pace of infections is not increasing as much as it is in the United States and Europe.
Certainly, I think that will, once the data is out, we would pay a lot of attention to it and then, seemingly move forward. And when we compare with the region, what you see is certainly most of the countries, if not all, have a V-shaped kind of rebound in the third quarter. I think in India had one of the strictest lockdowns. So I think that is which explains the, second quarter plunge and then third quarter looking better. Some of the other countries just contracted, say, single digits, some have about 6%. Some about 8%. In a country like Indonesia was only about 5% because they didn't go for a full-blown lockdown. Instead, they just put very strict social distancing measures and put restrictions on public transport capacity and all of that. So certainly the way the growth curve has developed has got a lot to do with the response mechanism. And I think that is why you would have seen different countries, in terms of growth react differently. And in the third quarter, almost everyone has, you've seen many of those restrictions being eased to different lengths. For example, Sameer had mentioned about the Western countries. You talk about US, Eurozone. In fact, US doesn't have too many restrictions as yet, but Eurozone had opened up pretty early and there was a lot of inter-country travel as well, which in a way aggravated, the condition there. And because of the faster reopening, now they have had to consider reimposing many of the restrictions. But in India's case, I think it was far more gradual. On a monthly basis, things were reversed. And as of now, where we stand is that states have been given a free hand to consider any localized restrictions. Of course, I think at the center and the states, nobody's going to consider a full-blown lockdown. But after the festivities are over, you can see that the states are being more proactive, more preemptive, trying to already put, even though the cases have not really increased too much, they have largely been stagnant, the growth, but they have opted to be preemptive. So I think that speaks a lot about how our response mechanism has changed as compared to April or May. So to that extent, I would think the impact on growth will not be that big as we go forward, but certainly the pace will matter. And if we do see a resurgence, like say the West, I think then we can expect a deeper contraction. Otherwise, I think in terms of better experience with handling this kind of a pandemic, coupled with the fact that we are not going to consider a full lockdown again, it's going to be more localized. Manufacturing, construction activity will not be restopped. Vaccine availability certainly seems much more optimistic. I mean, we have local players as well, and some players that have arrangements with the UK company. Certainly something that lifts sentiments. So I would think that is certainly positive tailwinds, and that will help keep the growth trajectory going up. So again, to answer your question, compared to the region, yes, the trend is very much similar. But the scale is certainly very different because we should see the response that we had put in the the June quarter as a base point to start with.
Let's take this a little forward-looking, Sameer, because that's where the big question lies. Where are we going to go from here? In that sense, do you think quarter 3 will be most interesting because the high-frequency indicators truly started to pick up post-September? You also have the festive season coming in. And then the big question is about sustenance. Today you had RBI Governor Shaktikanta Das also saying that the challenge is to see whether that festive demand sustains.
Right. So as of now, we have some indicators available for the month of November as well. So for instance, electricity demand is available, rail freight. The government also had released export and import data for the first week of November. Most of the indicators are much in line with what we've seen in October, though there is some tapering off. So even after incorporating that tapering off of some of the growth indicators, it is looking surprisingly positive. So in terms of Q3, we believe that our estimate for Q2 is -8. And in Q3, that number will be closer to perhaps 3% if we continue to see this kind of traction. The second thing which we should also remember is that in quarter 2, the acceleration of growth is mostly driven by private sector. if you look at the public sector, both the center and state put together, the spending has been very, very muted. Particularly, capex spending has been even more muted. But when the private sector activity picks up, as you correctly pointed out, from September onwards, there is a buoyancy to government's tax collections as well. When we've seen the tax collections in September, the indications are October GST tax collections are also very robust. For instance, the government's indirect tax collections in Q2 are increased by more than 11% compared to a very large contraction that we've seen in Q1. So if government, which has some headroom to spend, which it has not utilized in Q2, also comes to the spending, its budget spending, then there's very high likelihood that this growth perhaps will continue towards Q3 and Q4. And next year, any which ways, as we have a vaccine available, as Radhika has pointed out, you will see more and more services activity opening up, and perhaps the economy will come back on an even keel as we move ahead.
Well, the pace of the vaccine and its delivery is a whole different ball game. So we'll have to wait and see how that unfolds. But meanwhile, all eyes on that big announcement tomorrow. Thank you so much, Radhika Rao and Sameer Narang, for joining us and setting the tone for what will be an exciting day for economy watchers.